AI stocks are finally losing momentum while the rest of the market wakes up. If you're still positioned like it's early 2024, this rotation can either protect your portfolio or hurt it badly. Welcome back to AI Assets. Today, we're breaking down what it really means when Wall Street starts rotating out of AI and semiconductors into sectors like financials, healthcare, and industrials. We'll look at why this is happening now, what the market is getting wrong about it, and exactly how you can position before the next leg in this cycle. Let's start with what's actually going on. After an exceptional run in AI and chip names, investors are finally taking profits. We're seeing flows move out of high-multiple AI leaders and into more boring sectors that have lagged: banks, insurers, hospitals, pharma, industrials, logistics, even some old-school value stocks. The indexes don't show the full story at first glance. The S&P 500 can still look fine on the surface because the weakness in AI is being masked by strength in the rest of the market. Under the surface, a clear sector rotation is underway. So why does this matter for you as an investor? Because for the first time in a long while, AI is no longer a free lunch. We've moved from a phase where buy anything with AI in the pitch deck worked to a phase where the market is forcing every AI name to justify its valuation with real revenue, real margins, and real cash flow. The first analytical layer is investor context. If you hold AI exposure, Nvidia, AMD, Supermicro, Broadcom, Palantir, big cap tech with AI narratives, you're now sitting in the part of the market where everyone has profits to protect. That means any negative headline, weaker than expected guidance, or hint of slower AI spending can trigger fast, brutal de-risking. At the same time, sectors like financials and healthcare are finally getting some attention. Banks and insurers benefit from higher yields and relatively stable credit conditions. Healthcare and pharma offer defensive earnings profiles. Industrials and logistics ride on steady demand, reshoring, and infrastructure spending. This is classic late-cycle behavior. The market rotates from the hottest growth trade into sectors with more predictable earnings and lower valuations. If you ignore that and sit in the same AI basket you had 6 months ago, you're taking a very different kind of risk than you think. Now let's talk about what the market is missing. Most headlines call this the end of the AI trade or the AI bubble popping. That makes for great clicks, but it's the wrong interpretation. This is not necessarily the end of the AI rally. It's an upgrade in standards. In the early phase, anything AI-related got capital, regardless of whether the company made money. Now the market is starting to separate AI stocks into 3 groups. First group, core infrastructure winners. Think hyperscale cloud, leading GPUs, high-end networking, advanced memory. These companies sit at the center of the AI value chain. They won't escape volatility, but they have real pricing power and long-term contracts. Second group, real enterprise AI platforms. Companies that sell recurring, high-margin software, where AI clearly drives productivity, cost savings, or new revenue for customers. There's still huge upside here, but only for those who can prove return on investment. Third group, narrative stocks. Small and mid-cap names that live mainly on the AI story, not on the numbers. This is where the rotation can get brutal. When the price of risk goes up, patience for future profits someday collapses fast. Another thing the market hasn't fully priced in is how AI can compress margins in other sectors. Banks, insurers, retailers, manufacturers all can use AI to cut costs. But that same cost-cutting can mean suppliers and service providers lose pricing power. That makes AI both a growth driver and a margin risk at the same time. It's a new kind of ambiguity that traditional models aren't built for. Now, to the third layer, what happens next? And how can you position smart? First, watch earnings season. Pay close attention to guidance on AI-related CapEx and OpEx. Don't just listen to how much companies are investing in AI. Listen to how quickly they expect those investments to pay off. Second, track sector rotation in the data, not just in headlines. Flows into financials, healthcare, and industrials can continue as long as AI names are richly valued and volatility stays high. When that rotation slows, the next AI leg higher can begin, but it will likely be far more selective. Strategically, think in 3 steps. Step 1. Reduce exposure to pure AI story stocks with no clear path to profitability. If your AI thesis is more hype than cash flow, this is the time to cut risk. Step 2. Keep core exposure to quality AI infrastructure names, but accept higher volatility and deeper drawdowns as part of the journey. Treat them as a function of positioning, not a verdict on the long-term AI story. Step 3. Balance your AI exposure with sectors that benefit from AI-driven efficiency but are not yet priced like AI darlings. That could mean selected financials, healthcare names, or industrials that are quietly digitizing fast but still trade like old economy stocks. The bottom line is this. AI stocks are losing momentum right now because they've been winners for too long. This is not the end of AI. It's the end of the naive phase where everything with an AI label goes up no matter what. If you want to stay ahead of moves like this before they show up in the headlines, subscribe to AI Assets. We break down AI investments every day with a focus on what the market is missing and how you can position smarter. And now, I want to hear from you. Do you think this rotation out of AI is just a healthy reset before the next leg higher, or the start of a longer slowdown for AI stocks? Tell me in the comments below. I read every single one.